I'm Nick Grove for Morningstar.com.au, and today I'm joined by Morningstar's Peter Warnes, who's here to discuss the most recent batch of company earnings. Peter, thanks for joining us.
Nice to be back again, Nick.
First of all, Peter, Wesfarmers' earnings appear to be a little flat, but are they still performing in line with your expectations?
Nick, yes they are. Don't forget that report would have been including discontinued operations, which you've got to strip out the insurance operations they sold to IAG in the past year. And so if we take those out and look at continued operations, earnings per share are up 9.6%, and that's as good as we were looking for. Operationally, look, we know that coal and resources and anything to do with that space, and even the industrial and safety space, where it is, kind of resource and industrial manufacturing driven, was going to be under the whip. Look, at this point in time, Wesfarmers is a retailer. Total retail sales, including petrol, were up 4.1% to 30 billion. Group sales were 32 billion. So 94% of the revenue is coming from retail, and 93% of the EBIT's coming from retail. And of course the two engine rooms there are Coles Food and Liquor and Bunnings in the home improvement space. Now those two engines are firing as well as anyone could expect in this very, very competitive environment. There may well have been some disappointment with a slight slowing in headline and comparable store growth for the half, albeit that it picked up in the second quarter. And importantly, the deflation from the first quarter to the second quarter increased from 0.5 to 0.9. So what that's telling you is that in terms of volume growth or real growth now is pushing at almost 5% in food and liquor, and higher than that in food because they're still struggling in liquor. So look, these are very, very good numbers in a competitive environment. And as I said, those total numbers of 30 billion of sales and 1.97 billion of EBIT, the margin on that 30 billion sales base actually improved by 26 basis points to 6.4%. There's retailers out there going to kill for that. And so, look, Wesfarmers are doing just fine. Perhaps the market again might have been a little bit disappointed with the dividend only pushing up from 85 to 89, albeit that they very conservative. They'll deliver as the market expects, and with a low gear balance sheet, this company is core in any Australian diversified portfolio.
Peter, Woodside delivered a record set of numbers and a record dividend. Given the action we've seen in the oil price, does Woodside represent an opportunity at the moment?
Nick, difficult question. We still believe long-term value of Woodside is significantly higher than the current market price. So the short answer to that question is yes. I mean, it was a good result. Production or output was up 9%, and the prices aren't reflecting yet what's happening in the oil market the last quarter. And so the result was strong. The dividend reflected that strong result with an 80% payout ratio. Having said that, we were a little bit disappointed with the dividend. It could have been a little higher because they calculated on an after impairment under a profit rather than a pre-impairment one, but splitting hairs. Going forward, the result or the earnings for 2015 are going to be substantially lower because it will reflect the price of oil and gas around the lower oil price. But having said that, 4 billion of free cash flow in 2014 puts the balance sheet in great shape. Yes, they've gone out and spent nearly 3.7 billion on Apache assets, but they will kick in the second quarter of 2015, and they will offset some of this price weakness in oil. And so, look, we're still looking for a very, very strong result, albeit substantially lower. The dividend will be cut, obviously, because the 80% payout ratio will remain in place, we think. But at current prices, this is still looking like 4.8% fully franked on 2015 earnings, and we're looking for a better earnings in 2016 as we think the oil price will recover. Now, that's again the $64 question. So look, we like it in terms of long-term valuation, but to get through a volatile, short-term and very choppy oil market, which is being set by, let's face it, jockeys in the derivative space. You just got to watch the volatility. I mean, there's very, very little oil being set long-term, long-term oil. You can't go and buy it at these current prices. No one's going to sell you oil for 5 years at $50 a barrel. It's just not happening. So the spot, everyone gets rolled up in the spot, and they should get away from the spot. Spot's a dog. Let's just leave the dogs alone. So Woodside, we like that long-term.
Finally, Peter, this morning it was announced that Andrew Penn was going to take the top job at Telstra. Do you think he's the right man to take the helm?
Nick, I believe so. I mean, there's some strong operational candidates there in Gordon Ballantyne and Neeson, but I think at this point in Telstra's development, if you like, David has left it in a very, very strong position. He's repaired the market share in mobile with the help of Gordon, obviously, on the consumer side. The spectrum investment's been done. The network is now the best mobile network in the country, possibly in the world. The negotiations with the government are now complete on NBN. He leaves the company in great shape. Now going forward, I think it will be financial discipline continuing, and Andy coming up through the CFO channel, if you like, will now put his stamp on it. He's not going to do anything reckless, but the board will be there to make sure he doesn't. But when you write a cheque in telecommunications, it's always a big cheque, and I'm sure Andy will be very, very up to the mark on all of that, and I think it's a very, very astute appointment.
Peter, thanks for your time today.
Pleasure, Nick.